All right. Randy Patrick here, Housing Bubble 2.0 News of the Week for the last day of 2018. It is December 31st. Apologies for delay in videos. I've been busy, been a lack of news, hasn't been a heck of a lot interesting out there, and I've actually been shut down. We had an internet problem. The local provider that provides us with our internet service and our TV service, fiber to the house. I've been out for 5 days. The guy finally came today, strung new fiber, fixed the routers. I'm back in business, which is great. So clearly, doing this from Starbucks doesn't really work. So anyway, that's the scoop. So let's get into it right now. It's been a heck of a year in housing, and we're going to go over some of the highlights today. So really, a lot of people are stating it was one of the worst years in housing in like a decade. So, when you go back to the last housing crisis, that's kind of a big statement to sort of, I guess you could say compare to, but that's sort of what happened. And here's a lot of the highlights. So you can say that we peaked in value this year. Obviously, July, August, September, we were at 11.5 and 11.6%. On the Case-Shiller National Home Price Index, above where we were back in the peak in 2006, the previous peak before the housing bubble came on. So we basically hit a new value, and that's kind of interesting. As a result, you've got sellers that are out there looking for top dollar for their homes. We had a lot of low inventory going on this year, which caused competition, which caused buyers and bidding wars, and sellers really were in a great position. They enjoyed it. Multiple offers came in. Realtors were feeling good. Everybody was feeling great. It just got tougher and tougher for buyers to get into the market and actually pay the prices. So obviously, as a result, the lack of inventory caused prices to rise. And again, sellers weren't backing down, and it caused the buyers to really be in a bad situation. So what we really have is a scene where prices are up, low inventory, competition, and then interest rates are rising as well too. So obviously the Fed raised the rates a few times this year. They did recently in December here, another 25 basis points, and the buyer pool slowed down. The buyer pool basically had enough, I guess you could say. The industry term for it is buyer fatigue. So buyers can no longer, either they can't or they won't, pay high prices with higher interest rates and bid against other people for property. It's not going to make sense anymore for them. So again, it's costing people a lot more money to get into housing these days. And as a result, they're waiting on the sidelines. So we're seeing more and more inventory hitting the market now. We're seeing a massive amount of price reductions across the board, across the U.S., which is very interesting. And we've seen that the annual home appreciation has kind of plateaued right now, and it's actually starting to decline in some markets. So when you go back to the Case-Shiller index, it was 11.5, 11.5, 11.6. So really the appreciation, the year-over-year appreciation, there still was year-over-year appreciation, but it's not double digits. It's like 5.5%. It's slowing down. So the month-over-month is getting lower and lower now. So we're plateauing. In some locations, we've actually started to go down now. So that's what we're going to see. So the future is going to hold what? More price reductions, more competition with sellers. Sellers are going to have to be on the ball. Sellers are going to have to expect not to have bidding wars, and their prices need to be effective and competitive. They're not going to have days on market, 2 days, 2 weeks, and their house gets sold. Longer days on market are showing up now. So it's becoming a whole different ball game with respect to the housing market, especially in some of the larger locations. Obviously, the West Coast is getting hit hardest. So obviously Seattle, the Bay Area of San Francisco, the San Diego market, Los Angeles market, a lot of things are holding, more inventory is coming on, prices starting to decline, which is interesting. New York City market, obviously they've been in a year-long decrease, and more inventory coming on right now. The Dallas area is seeing this as well too. So again, Denver as well. So a lot of the cities that had a huge appreciation are now sort of going, oh my goodness, this is not working anymore, and it's shocking sellers. So that's the situation. Now, to add insult to injury, pending home sales, this is recent news. Pending home sales for November crashed 7.7%, according to the National Association of Realtors. That's the biggest drop in 4 years. Now, why this is an important statistic is because pending home sales that's what it is. It's a home that's pending. It's pending a sale. It's gone under contract, which basically means future closings, etc. So if the pending sales are down, that means less and less future closings, which means longer days on market, price reductions, etc., etc. So this will affect market values as time goes on, 30, 60, 90 days from now. So you got to keep that in mind. So really, that's the situation. But I think, when I take a look at inventory and values all combining together, what my main, I guess, takeaway is from this year is the fact that the speed at which this has happened. And it's been an enormous amount of speed. So that's what's happening, is that people don't think that it's going to happen to them, or the market's going to soften, or we're going to correct, or the bubble's bursting. And then suddenly, guess what? We see, 50% increase in inventory. Some places have a 90% increase, over 100% increase. We see 30, 40, 50% listings getting reduced across the board price-wise. So days on market's increasing. So it's happening faster than it's ever happened before. The numbers don't lie. So we're going to see the effect of all this come the new year for sure. And that's going to be interesting, because this is not a seasonality thing. I've read lately that some people are saying, well, we're in the winter months. This is the holiday season. It's typically a slowdown. Well, it is. I have to agree with that comment, but not to the point of where it is today. So again, more and more buyers wait on the sidelines, and the sentiment is, well, I want to see where interest rates are going. I want to see my options, and I'm not going to compete. I want to see where sellers are going to go. And yes, seasonality now, people don't really like to, leave, sell, move, etc. over the holidays. But once January hits, we'll probably start to see the real effects of what's happened over the past couple of months come into play. So there you go. Now, starting this year, we're going to see the effects of SALT, which is state and local taxes. So if you recall, there's the issue of the capping of on your deductions in your personal income tax of mortgage interest and state taxes, or local taxes for your property. So I think that was capped at about $10,000. So basically, or at least the taxes were, and I think the interest rates have a cap as well. So again, that will affect people. I know that, I guess the homeowners have sold because of that. People have moved out of high tax states like Chicago, Illinois area, like the California situation, the West Coast, like the New York City. I know that down here, especially the East Coast of Florida, a lot of people have sold their pricey, I guess you say, condos or apartments or homes in New York City area, Manhattan, Queens, Bronx, boroughs, whatever, and have relocated to Florida here. And obviously they're selling, they're getting money out of it. They're coming out here and finding there's more bang for the buck. There's no state tax, there's lower property taxes. So it seems to work a little better for people. So, and again, especially if you're a new buyer and you're taking a new mortgage and you're buying above that $1 million mark, then you're going to be concerned, because your cap only allows a certain amount of deduction, which means you're going to be capped and paying over and above that for new mortgages and new property. So again, it's causing a lot of people to think twice about how they're going to buy, where they're going to buy, what they're going to do. So we're going to see some shifting and relocating because of that. So that's a big story for this news year as well too. Home builders taking a hit. Home builders have been in the news quite a bit. Been a very difficult and tough year for home builders. Reason being, costs are up. Simple as that. Land costs are up, entitlement costs are up, material costs are up. We see all the trade wars. Skilled labor is tough to get and expensive at this point in time. So basically, the builders have been in a situation where they can't supply affordable homes anymore. They have to go up a couple notches in pricing, which means less homes will be sold. People will have to spend more money to get into those homes, but that's the area where they actually can make money and make margin. So again, less homes were sold this year, less homes are being built this year. All the builders had revised third and fourth quarter earnings. They've also had revised projections for fourth quarter and for 2019, which has done what? Causes their stock to decrease. So a lot of the main builders across the board, their year-to-date stock prices have dropped 30%, 25, 30, 35, almost 40% in some with some builders and some of their stocks. So it's unreal. And because of that, they want to clear out what they have left. So builders are reducing price. They're offering incentives and upgrades for buyers. They're offering realtors incentives to bring buyers to them. So again, bring in the customers, let's cut a deal. I mean, obviously the money's spent, they want to get their money out of it. So in the future, we already know that the permits are down, the housing starts are down, etc. And that's going to be a trend, as time goes on. And again, the reasons for that: higher interest rates and again, higher prices. So that's the point. So 2019 is not looking good for home building. And actually, some little piece of interesting information here. We should have heard the past week about the most recent statistics from, about home builders, etc. Well, that stuff is generated by the Department of Commerce, and because the government is shut down, that information is not available. So in a way, I think it helps the builders. That's the word in the street, that the fact that since we can't report bad news, they can't take any more beatings in their stock price and losses. So there you go. So they have a little reprieve for now, but I guess once the information comes out in the future, it'll probably self-adjust accordingly. But again, builders had a heck of a time this year. Now, if we go to the lending market, so obviously we're seeing less and less mortgage applications because there's less and less people looking to buy, and they're going to wait. Back to the whole buyer fatigue issue. We know that rates have climbed this year, and there's at least, recently as December here, a couple weeks ago, and there are 2 more planned rate hikes by the Fed for 2019. The number was designed to be 3, but it was brought back down to 2. But again, they could change their minds as well, because the Fed believes that the economy is strong, that growth is there, and that interest should rise, which I understand their position from that. Now, don't forget though, people are used to having interest rates in the 3s and 4s. So having 5s and approaching 6 is not really common for the past 10 plus years. So that's a bit of sticker shock to people. And again, when things are more expensive, when there is less inventory out there, which means you're paying more for a property than you probably should, you're comfortable with, you're stretching yourself. Having a small increase in interest rates makes a big difference in your monthly payments, and then of course what you have to put down. So we also know that the shadow banking industry, which is made up of what we call non-banks, the Quicken Loans, Caliber Home Loans, Carrington Mortgage, Penny Mac, etc. Those are non-banks. They're not really regulated the same way as the big banks are. So those banks are leading the way in loan originations, and also they are leading the way with respect to the subprime market. So funny enough, subprime after all these years has come back the past couple of years, and the non-banks are one of the largest originators of subprime loans. And again, my point I'm trying to make is the fact that here we are coming off a season of, we'll call it peak values, the highest we've had since the last housing bubble, and now the non-prime or subprime banking industry is coming back in full force, and that's the majority of the loans being originated. So again, the shadow banking has taken over as some of the largest loan originators, and they're also originating riskier loans. Funny enough, just so you know, the banks that have pulled back, like Chase, B of A, Wells Fargo, whatever, they're writing less and less loans. Obviously, their loan standards are more conservative, but funny enough, they fund a lot of these shadow banking lenders out there. So everyone's concerned that if that market falls apart, it's going to have some ramifications that come through the industry, which will hurt us once again. Again, remember, the big banks fund the majority of these loans that are out there. FHA just before Christmas said they're going to raise loan limits. So how do we combat high prices and high values and higher interest rates? Well, we raise the loan limits. So FHA raised the loan limits in almost virtually every county across the country for the upcoming 2019 year. Very interesting. And Fannie and Freddie obviously did their part by, I guess you could say, pushing low down payment loans, the 3.5% down loans, so to get you in the property quite easily with low down payment. And also they've increased the debt to income ratio. So it was in the 30s before, went up to 43%. Now there's many cases where we're looking at 50% debt to income ratio. So when you have a combination of 3% down, 50% DTI in a highly appreciated market, when you're paying a premium, to me that spells trouble. And if there is a small swing in valuations, which looks like it's going to happen, then guess what? You're negative equity. You're underwater virtually immediately, because in theory and in practicality, you put 3% down, you try to sell your house, you got closing costs, probably some commissions. You're bringing more than it's costing you more than 3%. To close out that property. So you're going to be negative equity right away. So not a good scene for buyers going forward. So, and having said that, we have a lot more people trying to play in the marketplace. I think that was a factor this year as well too. First of all, there's more and more TV shows about real estate and rehabbing and home searching and values and flipping, all the stuff on TV. It's out there. All the TV shows have rolling, I guess you could say, events that come to major cities across the board, so you can buy in their programs and learn how to flip properties, etc. So I counted back in the fall about at least 150 of these shows on the networks out there, and that's just the active shows. I'm not talking about the stuff that's archived or you can watch online that's happened a few years ago. I'm talking active shows. I looked at all the websites and all their TV program. That's what I found, about 150 real estate related shows across the board. So more and more people are coming to real estate, which leads to more and more investors. So more investors are trying to get in the market, trying to flip property, but flipping values or flipping volume is down because there's less property to flip. okay, taking longer to flip. It's costing more money to flip, and also flippers are making less now. The past few quarters, they're making less money than they used to because everything's so tight, okay? It also leads to more and more real estate agents. So more realtors come on the market because when the market appreciates, everything's great, people jump in because they think it's a great opportunity. I can make a quick buck and whatever. So more and more realtors have hit the marketplace, and that's a problem. More entities are trying to gain market share as well too. So hedge funds, other large buyers, other groups are trying to supply real estate information, real estate products, whatever. You've got more groups trying to buy property and really replace the realtor market as well too. Zillow, for example, is launched in many locations. You know, it'll buy the house and resell the house. You've got these open doors and things like that who are basically saying, you know, name your price, name your closing, we'll take it. And the whole idea is that they're buying and selling property and they want to get to the client. So it's application, internet-based, basically cutting out, you know, third-party realtor activity. That's the game plan here. Now that may work great, but if it's only in an appreciating market, so if I can buy it at X, put some work into it, sell it at Y, I'm going to do okay if the market continues to rise. But now that we're plateauing, we've plateaued and are actually starting to decline now, those models don't work that well. So we'll see what happens in the future. And this is, I mean, a lot of competition just for people's attention to sell their homes. So that's kind of what's happened this year. My biggest takeaway, though, is, you know, having lived through the previous housing crisis and bubble crash crisis, participated in that, and I've seen it all happen once again here. Back in the day, people denied it existed. So, you know, the then Fed chairman denied it, didn't think it was going to happen, and look what did happen. We had people just not believing, and we were all shocked when the housing market crashed. Well, now it seems like people know it's coming, but they're a little bit slow to react to it, or at least to talk about it. So I call this like no more denying it. So basically, back in the fall, we had the Redfin CEO who said, hey, you know, it's a perfect storm for real estate right now. Is a housing bubble, high interest rates, low inventory, the whole bit, high values. He goes, that's not a good thing. So he was kind of calling it out. Bank of America, the chief economist for Bank of America Merrill Lynch, called out the market itself, saying, hey, call your realtor, sell your house, get out now. And they felt that the best part of the market was almost a year ago, 2017 in November. They felt that was the best time to sell your real estate. The market had peaked in various formats. Robert Shiller, who of course is the co-creator of the Case-Shiller Home Price Index, I guess you could say he stated his concern with the numbers. He said definitely there's a slowdown, things are changing. You know, he's not saying more than that, and I've commented on this before. He's not saying more than that because I think if he does that, it's going to cause a bit of chaos. So he's kind of hedging his bet, saying he needs to see some more data. I'm sure he knows what's going on and what's coming, but he's not really saying it out loud or as much as he can, so to speak. Robert Burns, who's a well-known economist and I guess you could say analyst and consultant for the home building industry, basically said it's in a market correction right now. It's going to be a tough 2019, bad year, been a bad year for a while. He basically called it a correction. And there's other CEOs of large brokerage firms or commercial firms out there that said, hey, we're in a housing bubble, it's here, you know, figure it out and live with it. And that's my position too, is we're watching it happen in front of our eyes, which is a great position to be in, and we can react accordingly. But going back to some of the main points I said earlier is the speed of information. And as we know from, you know, watching the news, looking at the internet, blogs, articles, newspapers across the country, we can get a litmus or kind of a feeling of what's going on in various locations, and we can see it happening before our eyes, which is really, really interesting. So I know what's going on in Seattle. I know what's going on in Orange County. I know what's going on in the Bay Area. I hear what's going on in Denver and Dallas and Chicago, New York City and Miami. You know, so all these things are starting to happen now. And it usually starts with the mega cities, the West Coast, the New Yorks, Miamis, etc. Tends to start and then sort of works its way inland and to smaller or more medium-sized markets. So we're seeing a lot of shifting right now and relocating to different climates and to lower tax locations. We've seen another big play here is the reduction or lack of foreign flight capital into our markets. I do believe, especially in parts of the West Coast, that the money from overseas was a big factor in competition and in growth, and that money's not there to keep propping this market up because they didn't really care what it cost. They bought it because the primary objective was to buy a property to get the money out of the country, establish a domain here. So again, that's changed now because different regulations, different rules, different scrutiny. A lot of those countries where money came from have really clamped down on the exodus of funds. So that's changing the market, not just here, but up in Canada and other locations as well too. We're seeing that happen. So global housing is starting to collapse as far as we speak. So that's kind of my scene here. So my perspective is we're in a housing bubble right now. It's only going to get worse. It's great if you're buying, right? That's if you want to buy your dream home, or you want to buy a great investment property. You sit and you wait to see what happens, because more will come to light as the new year comes along. So again, I want to say I appreciate everybody's views, comments, intelligence you've given me for 2018. I really do appreciate it. The design of this channel was not intended to be where it is today. It was actually to support another application I'm working on, and it kind of took off. So it surprised me quite a bit, but I do appreciate everybody participating. I think it's been a lot of fun, and I think the cool thing about it is we get to read the comments and you hear what's going on in the rest of the country, which I think is great intel and great knowledge that we have out there. So I enjoy your comments. I like your questions. I'll answer them as best I can. If you like what you hear from me, please subscribe. I've got more planned for 2019. I think we're going to have a great year. The 2019 is going to be a year of change and chaos in the housing industry. It'll be interesting to see how it all plays through. So we'll have to figure that out as time goes on. But hey, I'll do the best to give you the intel I have and give you the opinions of what I see, what's going on, and try to get us to a place where it makes sense for everybody in real estate. So everyone, we'll be back at it in the new year. Everyone have a safe and happy New Year's Eve today, and have a happy new year. And we look forward to more of this great housing bubble 2.0 fun and games in the new year. So thank you, everybody, and we'll look forward to speaking soon.